Hello and welcome to this very special interview. Joining me today is someone who spent close to 30 years of his life and most of it, working life, in social impact. Uh, it's very rare to find people who engage in a career which is over such a large period of time dedicated to social impact. Steve Hardgrave, who is the co-founder and the CEO at Varthana, uh, which is a company that is seeking to provide educational loans to sections of the society which find it difficult otherwise to procure this loan. And before this, Steve has worked, as I said, for a better part of his working life in various social impact companies across the world. He has co-founded Varthana about 10 years ago. Steve Hardgrave, thank you very much. As I said, it's truly an honor to speak to you. There's so much that needs to be done in our country, and you've probably picked the most important part, which is education. My first question, how has your 10-year journey been? What's the problem that you're seeking to solve, and where have you come in the last 10 years? If you could tell us a little about that.
Yeah, absolutely. Thank you. It's a pleasure to be here, and thanks for giving attention to this topic. You rightly said we see it as the most important thing for India and for the world. Really, why we've done this is to try and improve this intersection of access and quality. And typically, what you would see as that quality of education goes up, fewer and fewer people have access to this, usually represented by the cost of education. And so you have very high-end private schools in India that are world-class for only a small segment of society. And then you have many government schools that struggle to provide a decent quality because they're overwhelmed. And so it's free access, but very low quality. What we saw was over the last several decades to fill this middle void, hundreds and thousands lacks of private schools that are independent, that are locally run by local people, have sprung up very organically. And when we saw this reality, we saw that these schools, though there are just 4 lakh of these schools, and government schools outpace them by 3x, we saw that now practically half of all enrolled children in India are attending these private schools. And we saw these school owners struggling to access resources, primarily financial resources, but also educational resources that would help amplify their efforts, improve their quality, expand their capacity. And so that's the sole reason for existence of Varthana, is to operate at this intersection where at one price point can we not help improve the quality and even lower the price point for the same level of quality. We started out by working with the school owners, and so this is primarily primary and secondary education, K through 10, K through 12. We've been able to attend to roughly 8,500 of these schools over the course of our 10-year journey. And over the last couple of years, we've now added on direct student loans for higher education, post-secondary, to help those kids from this kind of a background be able to carry on with that super value added last mile of education that gives them preparation for the jobs of the 21st century.
Steve, you know, education inflation on the one hand in our country is double digit. You talked about there is the whole government school where you can get extremely subsidized education, and then there are these high-end schools where the costs have just ballooned. But I'm sure even in this middle space that you are in, education inflation is a reality. And at some point, when the child is going to finish school and go to college, private colleges are even more expensive, leave alone going overseas. But the good thing is that today, when one looks at most of the topper lists across competitive exams, you see children from smaller towns and cities, from marginalized sections, economically marginalized sections, who seem to occupy top slots. Uh, you talked about the fact that you initially were providing support. If you could elaborate what support and in what form do you provide to individual school owners, that would be useful for people to know.
Yeah, absolutely. I'll speak first on the finance side. In terms of the loans that we provide, they can range anywhere from, say, a 5 lakh loan up to 5 to 8 crore. Typically, these loans are used for expanding the infrastructure, but we don't require that or restrict it to that. Basically, anything that helps improve the quality of education or expand the capacity of the school, we're very happy to finance. So some people take loans to invest in improving, say, a science lab or the technology that they have at their schools, sometimes for purchasing buses, but oftentimes it's to expand a second floor on the school building or maybe to acquire an adjacent plot if they're getting larger. And so that's the lion's share of the financing goes towards this capacity expansion. In addition to that, what we try and do is connect these schools that maybe are in tier 3, tier 4 cities with some of the educational resources that tend to be more available in tier 1 and tier 2 cities. So we have tie-ups with a number of providers, some of them technology-based, some of them didactic materials or different curriculum. And we extend those offerings to the schools. And of course, if it's helpful to finance the purchase of those offerings, and then we accompany that with financing as well. And then we have our own in-house team of education specialists that tries to provide a certain amount of content and gyan to school owners and to teachers directly through webinars and different publications. For example, in COVID, we developed a whole series of printed materials. The schools that were technology enabled in COVID were able to switch to this digital remote modality. But the low fee schools that attended the lowest income families, those families wouldn't have had technology. So we created these unlocked school packets that the teachers were able to deliver home to the students so that they could have some stimulus and some ongoing activity. They could turn them in and get them marked up and carry on with some level of education throughout this huge, roughly 2-year period. So we try and accompany the finance with these types of interventions as well.
Let's talk about the education loan piece. How different are you from, say, other NBFCs or probably public sector banks? I'm not talking about private sector banks, which probably haven't yet gone to the ticket size that you are probably at. But if you could give me a sense of which category, geographies of children do you support by giving education loan, and how are you different? If at all there is anybody else providing loans to this section of society.
Yes, I would say that, as you rightly mentioned, earlier public sector banks were fairly active in giving college loans for undergraduate degrees or graduate degrees, but their experience was usually quite poor in terms of repayment, and so they've really lessened those efforts. If you look at a lot of what's being currently offered today, it's kind of in this new age fintech space. Some are NBFCs, others don't actually have the NBFC license, but they're providing front-end access and have an NBFC or a bank behind them. Many of those types of initiatives are focusing on the EdTech offerings, the online course offerings, because it's very frictionless and easy to operate without a large team. We do attend to those spaces, but I think what really separates us is we tend to partner with a lot of the brick and mortar post-secondary education alternatives, be that colleges or even vocational and technical training, where you're getting courses that are very practical courses. It could be in the aviation sector and the electric vehicle sector. And these are courses that might have a course of 4 months, 6 months, even 1 year. And the way we structure our offering is, if it's a younger student, then we focus on the family income. And rather than the typical education loan where you get a moratorium period and you start paying after you graduate, we look for the family to start paying immediately, but at a level that accommodates their household income so that it fits well within their budget. And those payments then might continue after the student has graduated. But we want to be able to see that intention and that discipline from day one. This also helps reduce the balance so that over the course of the loan, they're not paying as much interest. And given that we do attend to some of the segments that might not be, see these ed techs that I mentioned, the fintechs, they tend to focus on very high CIBIL score, salary, healthy banking, because they want something they can approve in 30 seconds with an algorithm. And the students we tend to attend to, they might have jobs in the informal sector. They might not have a robust credit history. So it requires a little more risk and a little more manual underwriting, which is why we do need to charge a little more of the risk premium, which we try and compensate by having the loan run down more quickly.
And what is the typical ticket size of the loans that you provide
It's about 1 lakh on average.
per student for higher education or for school as well?
We don't do any school lending in the like K through 12, student lending in the K through 12 space. Our logic there is at that level, you cannot upgrade a family from a 600 rupees a month school to a 1200 rupee a month school. The payments would overlap and you'd be indebting that family for many, many years. So what you would be doing is really just an income smoothing over the course of 1 year. And we feel that the schools themselves are in a much better position just to collect in several installments throughout the year. When you get to higher ed, you can afford to help that student really upgrade to a better quality offering because it's a short term and then they're earning. And so I hopefully this fits very well with some of the financial education that you focus on about when is it appropriate to use finance and what have you. We try and be sensitive to the right context.
Absolutely. I think that's very important what you're saying, because the whole idea of being in debt for a very long time is not a very prudent thing for a young person. You talked earlier about you also provide loans for vocational, technical education. Skilling is something that is, at the heart of the current government and the previous government as well. The skilling mission was started back then, but a lot of impetus is now being given to the importance of skilling and not just going out there and getting the traditional degrees that, in India, those opportunities were very limited, but things are expanding now. Universities are offering skilling courses, degrees in skilling. Is that an area you see as a far more compelling one for the kind of segment that you target, that get yourself skilled, start earning, be an entrepreneur?
Yeah, absolutely. And here we're very pragmatic. There might be some ideal about a university education, but this is very costly. And the harsh reality is that a lot of students have not come up through a high quality primary and secondary education where they're those toppers that will get those few seats. And so even if you look at that, the difference of your lifetime earning capability, if you're unskilled labor versus some sort of a skill, is a huge, huge difference. That really, that return on investment for that vocational or technical training is very, very high. And so we're firm believers in this market, and it's a very unattended market because from a lender's perspective, it's difficult to be sustainable with smaller tickets over a shorter tenor. Just because of the nature of the income pattern. And so it's an area that we feel compelled to try and crack through, being a little more efficient and there and present in this segment where others might not be. But I think especially when you look at the demographics of India, there's a huge need for this.
And, in your 10-year journey, I'm not asking you for the amount, but have you been able to make this a profitable business as well? I mean, I know that there's a larger purpose, but at the end of the day, you are a business, and I'm asking you this question because over my 30 years of interviewing many, many people who are from the BFSI space, everyone says that it's the bottom of the pyramid which matters. But at the end of the day, there's a reluctance to go down there. It's still largely a tier one, tier two, kind of a business. Very few people have been able to probably, really go down there. And those who did are also in some ways because of various reasons, inefficiencies, lack of technology, not being able to sustain, as you mentioned earlier. So have you been able to prove the fact that there is money to be made also profitability at the bottom of the pyramid.
Yes, I think we have, and it's been a very satisfying experience to see in the early days the funding that we attracted almost came exclusively from these impact investors who have an explicit social mission but want to see a profitable, sustainable business. And as we've grown, we've been able to source both equity and debt from straight commercial players that don't explicitly have a social concern. They're not necessarily bad people, but we're able to generate that return. And pre-COVID, we were on a very healthy track of making good margins and good profits. Now, COVID was just devastating to this sector. It was, I can't overstate how bad COVID and the government reaction to COVID was for education in India, and therefore we were affected. We're now rebuilding that and back getting on track. The school loan, for sure, business, we've been able to prove that. That's been our bread and butter. Of our 1,000 crore portfolio, that's most of it. About 100 crore today, or a little over, is just the student loans, which we've been doing for a couple of years. And I think there the key is what we've seen some of the other players do is grow very, very quickly and then have an overhang where they've realized that they weren't correctly evaluating the risk. So they're having very high write-offs and NPAs. We've moved a little slower on that business just to try and dial in and refine. We're now breaking even on just a 100 crore portfolio, but this is a much more technology-driven business. And we have the luxury that we're not a startup, so we don't have to prove to the next round of investors the hockey stick is going up and to the right. We have the luxury of being a little more methodical there, but we're waiting for that moment where we have confidence that our risk metrics and algorithms are all down so that we can, push the accelerator a little bit because there is such an urgent need for this book to grow.
100 crore may seem small, but then when you talk of a ticket size of 1 lakh, it means a lot of young children that you've been able to fund or provide loans to. How many students from these small towns, villages have you been able to fund for their higher education?
Yeah, since some of that portfolio runs down more quickly. So over the few years we've been able to do this, the number is about 15,000 students that we've been able to finance, which, in some countries you'd say, well, that's a pretty cool number, but in India it's like, oh my goodness, it's not even scratching the surface. So yeah, we take heart in making a little progress, but we see the mountain ahead. And even on schools, 8,000, almost 9,000 schools, but there are 4 lakh out there after 10 years. So we are very motivated to, build on this early, foundation.
One final question, Steve. You said that, because of your schedule of payment and the segment that you're looking at, you charge a certain premium. So vis-a-vis for a child to say go to a public sector bank or an NBFC and coming to you for that loan, of course, presuming they're willing to give the loan to that child or to that family. What is this premium? I mean, how much more do you charge?
Yeah, that's a great question. And this is always an interesting one because for most of the customers, this would be a theoretical premium in that the public sector rate would be on the books of the bank, but not offered. But I would say that, and then the other thing is, given that it's a small loan over a short tenor, this kind of exacerbates the need to charge a little bit healthier rate. So we would be talking about as high as 500 basis points of difference between that theoretical rate that they couldn't get access to and ours. Now, what we often do is we work with the education institution such that they cover a portion of that, because what's also happening is if you have an institute, let's say with 100 seats, but you're only filling 80 seats, and because I can help you finance some of the people that otherwise wouldn't be able to pay, you might fill the full 100. Now, the cost for those extra 20 seats, you still pay the teacher, you still rent the building. So every additional student actually comes almost to your bottom line. So that's where the schools can help cover that interest cost for some of these lesser advantaged students, and it still makes sense for them. So we have these types of arrangements so that the student doesn't feel the pain.
But compared to, say, a personal loan, because I would imagine right now the only recourse other than the local village money lender would for a family be to either pawn the jewelry or probably go and take a personal loan, which is available at very high rates of interest, but available on tap. Even in sections of society where probably these kind of high rate products should not be offered. But do you compare much better, at least to what is available in the market?
Yeah, absolutely. Compared with the local hand loans or money lenders, we're almost half the cost of what that would typically be, and which is would be generally their default. We would be cheaper than gold lenders most of the time as well. So you have to find and your middle zone, and we're battling on two ends. One, like I mentioned, it's a riskier segment. It's a little operational intensive, and then as a smaller NBFC, our cost of capital is something that we need to work to reduce. And so hopefully as we grow and reestablish our track record post-COVID, we can drive our cost of capital because it's, as that goes down, I'm happy to pass that along to the students as well.
I know I said final question 2 questions ago, but it's wonderful talking to you. So one more last one. Uh, Many people feel that, if, and this happens actually, if you look at even from businesses point of view, when, you're lending to, say, smaller businesses, there is a tendency to believe that the default rate would be higher. Of course, now there is a change in approach. And again, young companies like you have come out there and are funding small businesses. Is it correct that as you go lower down, that the risk of default increases, or is it that there is also a social intent driven factor at play here, that just because I do not have the kind of money that somebody else has doesn't mean that my intention is to default? I probably have a better intention to pay back. What has your experience been over the last 10 years?
Yes, I think that is exactly correct. When you look at underwriting, there's two key lines of thought that you factor. One is the ability to pay, and the other is the intent to pay. Ability is usually easier to identify because you're looking at financial statements and that sort of thing. The intent is much more difficult. And so I would say, as we have methodologies that get, and ability to pay can be a little opaque in schools because they don't have IT returns and a lot of the formal. So that's really the art of underwriting here. But to your point, I would say there's no less level of intention to pay. In fact, I'd say people that are more excluded very much carry that burden, that they know that this is their one avenue towards proving their credit worthiness, and so they don't tend to play with that. So we've had very good luck, whereas I've had schools, where I'm going to collect and I'm, walking past the Merc and the Audi of this school owner who says he doesn't have money to pay me, right? And there's clearly an intent issue there. So yeah, I think there's very good intentions, and it's just you need to understand how to identify what is the income stream in the informal areas.
An absolute pleasure talking to you, Steve. I look forward to many more conversations as you progress on your journey ahead. And I wish you all the very best and look forward to chatting again.
Likewise, thank you.